Global bond market remain on edge as the yield spikes in the US and Japan ripple across emerging markets. The rupee tests record lows and the budget related borrowing expectations influence domestic sentiment. To help us understand what this means for the fixed income investors in the month of February, we have with us Mr. Abhishek Bisen, Head of Fixed Income at Kotak Mahindra Asset Management Company Limited. Welcome once again to the show, Mr. Bisen. So, how will the record high financial year 27 borrowing estimate, which is 16 to 17.5 trillion, impact government security yields ahead of the budget?
If you look at year-on-year basis, on a gross level, both center and state, in the current year, we had overall supply of close to around 27.5 lakh crore, which potentially can go towards 29.5 to 30 lakh crores. That is primarily due to maturities, because earlier year issuances are maturing in the next financial year. Purely from the central government, it is somewhere around 5.5 lakh crores, and from the state government, it is around 4 lakh crores. So incrementally, that 2 lakh crore which we are looking at, 2 lakh to 3 lakh crore higher borrowing, is primarily coming due to the maturities. And maturities typically have their own demand. Having said that, overall market is slightly concerned because of the overall higher borrowing in terms of absolute numbers. But alternatively, you should also look at that the RBI has already bought around 5 lakh crore worth of bond for the current financial years, and it is slightly higher than that, which gives a reasonable amount of comfort to the market. But since the global environment is slightly uncertain, therefore yields are slightly uneasy. Going forward, as things settle down, we believe market will find value in the higher yields, and yields will either move sideways or ease with time.
So, with the US 10-year yield jumping to 4.30% after the Japan bond shock, what spillover risk do you see for Indian yields?
So globally, we are seeing a lot of uncertainties. One side, we have a war-like scenario. Other side, we are playing on a high tariff game. Other side, you see the bond yield shooting up, be it Japan, be it Korea, and other parts of the world. So a lot of uncertainties. It's an uncertain environment going on. So given that scenario, we've already seen this 2025, the yields shot up despite reasonably good macroeconomic situation in India. If you look at inflation, we went almost less than 2%. On an average, it will be around 4.5 for the last financial year, for the next financial year, both. On the growth terms, we were comfortable at around 7% growth. RBI did more than 5 trillion worth of OMOs and continues likely to do more in the next financial year as well. So, the yields, despite all these things, yields hardened from the low of 615 to almost 670 on the 10-year bond. So we have already seen the spillover effects due to uncertain times, due to supply, or whatever we may call it. We don't see a significant impact coming on incremental basis. So because of the underlying value spread terms, the repo rate is at around 5.15. There is value in terms of spread in the 10-year bond yield and across the curve, especially in the longer end side. If you look at SDLs, they are trading at 60 to 70 basis point on the various 5 to 15-year segments. Both are attractive. Absolute yields are trading at around 7.5% on various points of the curve, which are fairly attractive from a spread point of view. But given these uncertainties around the world, noise around the world, unless and until they settle down, it is difficult for the yields to come down in a meaningful way. Having said that, it is likely to drift sideways for a longer period of time and eventually catch up with the macros as and when things settle.
So CPI inflation in December 2025 stayed low at 1.33%. Does this create a clear room for early 2026 rate cuts?
That's a tricky situation for the RBI. Given the set of macros we have, well, there is space. But if you look at whether they should do or not, as I explained it to you, the global environment uncertain, economic shocks are unprecedentedly, things are moving haywire in the global scenario. Therefore, in such an uncertain time, whether RBI will take that stance to go for one more rate cut, we are not sure. In the current setting also, the yield should have been a lot more lower. But having said that, they will ensure that market is reasonably liquidity, availability of liquidity is enough for the economy to grow, and the rates remain comfortable. It should not be an adverse shock incremental basis for the economy to have an adverse impact. Already we are in an uncertain time. The growth momentum will get impacted. And if you take the bond yields higher, it is going to have an adverse impact. Therefore, both should not adversely impact the overall economy. So rates are likely to remain softer or sideways for a reasonably long period of time.
So, Mr. Bisen, despite 2025 rate cuts, Indian yields stayed elevated due to global pressure. Do you expect the same pattern in 2026 as well?
As I explained it to you, we don't see the similar move. While there will be volatility, but the move is largely likely to be sideways, and eventually it should catch up with the macros. And as I explained, the spreads are towards on the higher side. Like for example, if you look at repo rate and the 10-year spread, it is almost trading at 150 basis point versus the normal average of around 100 basis point. So either you take the repo rate higher or bring the spread lower towards the mean. That's what ideally should happen. So the chances of the repo rate to go higher is very low. But the 10-year definitely can either move sideways or ease over a period of time.
So the rupee breached 91 per dollar, driven by FII outflows and tariff tensions, right? How does a weak INR needs alteration in investors' debt market strategy?
That's again an interesting one because if you look at INR in a absolute way, it is depreciated. But is it because the fundamentals of the economy, or it is because the global issues? It is largely due to the global issues. That is one. Two is what is the extent of underperformance? If you measure it on the year basis, it is reasonably cheap. That means it is likely to help the exporters to become more competitive in the exports sector and likely to help our exports going forward. Therefore, situation is likely to become much better because of the depreciated rupee. Hence, RBI may not be required to take any measures. Had it been because of our own fundamentals, like what happened in 2013, probably the debt investors should have been more worried and things would have been much worse from what it is right now. So it is just the mirror image of that, because it's not because of your fundamentals. Fundamentals are becoming stronger. Rupee depreciation is likely to help the exporters. And going forward, the key will be the trade deal, like we've already done the FTA with the EU. Probably sooner we will also likely to do the trade deal with the US. And once that happens, the rupee situation is likely to get arrested. And effectively, the bond yields are likely to become much more calmer going forward.
So please also tell us, how should investors evaluate debt fund categories today, based on yield to maturity or on expected rate cycle timing?
Again, an interesting one. In the recent history, any chapter you pick it up, any risk-off sentiment has led to softer bond yields, or any war-like situation has led to a higher bond yields. So if you recall, when the war-like scenario began, the geopolitical uncertainty began, the bond yields didn't react as much, right? But of late, the risk-off sentiment has led to a sharp rally in the. It is getting reflected in the gold and silver or the precious metal prices. Bonds are getting sold off, equities are getting sold off. Both the asset classes getting sold off. So in an asset allocation model, Your equities are getting sold, your bonds are getting sold, equities are cheaper, bonds are cheaper, but the metals are reasonably expensive by any measures, whatever you have seen in the history. Therefore, definitely needs some amount of attention for reclassifying your asset allocation, some amount of profit taking, you may say, or fresh money to be allocated in the rest of the classes, depending on your objective, investment horizon, risk appetite. You must look at rebalancing your asset allocation. That is the probably need of the hour. And since the bond markets have been selling off, yields have been becoming higher and attractive, there is reasonable amount of value for overall portfolio safety and stability perspective. Debt should be a reasonable component depending on risk appetite. And since there is value, you should concentrate on the mid segment for stable accruals. Because if situation continues like this, and if there is recalibration in the asset classes, both equities and bonds are likely to perform much better than metals. And probably the next year when we talk the same show, things will be just the reverse. Just imagine what kind of portfolio returns you would be sitting on.
Thank you so much, Mr. Bisen, for joining us and sharing your perspective on the evolving debt market environment.
Thank you.
We hope this conversation helps our investors approach February with clearer understanding of yield dynamics, duration calls, and risk management. For more such conversations, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.